God.
Good morning, good afternoon, good evening, wherever you are. We are Martin and Chelsea Matthews. Welcome to our webinar this week. This is my beautiful wife, Chelsea. Go ahead.
Hello, how are you? Welcome. We're so excited to have you here with us. Today we're going to be talking about how to become your own bank. And we'll talk a little bit more in a minute if you don't already know who we are, what we do, and why we're qualified to give you this information. But I want to tell you really quick why we're bringing this information to you, why we're doing this event, because this information we're going to share with you, it really is life-changing for your business, if you have a business, for your life. And we didn't always have this information. It took us a long time to learn it, to apply it, and then be able to explain it in an easy to understand way. And in fact, you know, before I met Martin,
before you get into that, I want to make sure that everybody's seeing everything clearly. So if you guys can hear us okay, just drop a comment, make sure that you can hear everything good. That it's all coming through loud and clear. Wherever you're from, drop a comment in there so we see who you are and let us know where you're from. All right.
Okay, so good to go?
Yes.
All right. So why are we doing this event? Why are we bringing it to you? Well, like I was saying, it took us a long time to learn this information, apply it, and be able to share it with you in an easy way to understand. And before I met Martin, I was a single mom for 7 years, and I really struggled to find a balance between family success and financial success. And I felt like I was failing at both. And I felt like I had to choose one or the other. And I knew there had to be a better way. If I was spending time with my son, I was broke. Or if I was making money, I wasn't spending any time with my son. And that was not the example I wanted to teach him. That was not the life I wanted to live. And so I knew that I needed to get better information to be able to create a stronger financial situation for myself and my son, and to teach him so he could have all the tools to be successful as well. And I knew that if I could figure out a better way, I could not only improve my life and my son's life, but I could help other people too. And so I went on this journey. I read books, I went to seminars, and I started getting the right information about how money actually works and how to make it work for myself. And I met this group of financial advisors who Martin was actually working with, and they were teaching people how money works. They were making money doing it. And I was like, yes, this is what's for me. This is what I want. And Martin kind of took me under his wing and showed me the ropes. I thought he was just like a nice guy, you know, but I learned he had some ulterior motives. But once we got to know each other and we realized that our goals were so aligned and the impact that we wanted to make was so aligned, that we decided to combine our business and our life. And now we're able to strengthen our financial house and help others to do the same. And so, you know, we're bringing this information to share with you so that you can strengthen your financial house. And as we're giving this information to you, we're not saying we're so smart and you should just listen to what we're saying and you should just do what we say. We want to actually help empower you, and we're going to tell you how we're going to do this. We have some slides as well so that you can follow along to what we're saying. You can also see some of the important pieces of information. And so, are they up?
Yes, hang on a second. So before we get into some of that, if you like our content, please share. We're also authors of this book, Let's Fight About Money, about couples and money. So by the, did you want to say that? But I don't know if you forgot about it or not.
It's in the slides.
Okay. All right. So I'm going to put Chelsea's slides up and we'll get going on that. So just give me 1 second here. All right.
So what I was saying is, you know, we're not just telling you this information because we are these geniuses. We want to empower you with the information we've learned and implemented and help our clients with. Do I just hit down or enter?
Hit the next one.
What's the next one? Okay. And so the way we're going to do that is we're going to help you increase your knowledge so that you could take more responsibility for your actions and your results and have more control. And When it comes to knowledge, responsibility, and control, the subject of finance is one that everyone can increase their level of knowledge about. So whether you're just starting out or whether you're super, super successful, there's always another level. There's always more to learn, to implement, to get to that next level. And with greater knowledge, you can take greater responsibility and be in control of your finances and not the effect of them. I definitely want to be in control of my finances. I don't want to be controlled by them. So if you don't already know who we are, we're Martin and Chelsea Matthews. We're founders of M Wealth Group, which is a financial services and life insurance agency. We have clients in 46 states where we have a combined 19 years experience. And we lead an agency of associate advisors. We've also held multiple licenses in the fields of investment advisory, securities, and insurance. So we're actually legally qualified to share this information with you. And as Martin mentioned, can they still see me too?
Yeah.
Okay. We're authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And at the end, you guys are going to get an invitation to get a free digital copy of this book.
So make sure to stay through to the end, because then at the end you'll get a link to get a free digital copy of that.
Yes. So we help individuals and businesses properly use cash flow to create personal wealth. And our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can be free to live life by design. So you've heard me talk about or mention unbreakable financial house a couple times, and we'll talk about what exactly is an unbreakable financial house. We're all building a financial house, whether you're aware or not. You may have a financial shack, you may have a financial mansion, or you may be somewhere in between. And so what we do is we help people identify where they are, what kind of financial house you want to build, and then how to get there. And to do that, your financial house is made up of 6 building blocks. And when you implement these 6 building blocks correctly, you strengthen your financial house. And when you master them, you can have what's called an unbreakable financial house, which means you have unshakable, unbreakable finances. No matter what happens, you can handle it financially. But beyond that, it's not just about being able to handle things financially. It's about creating the life you truly want to live and making the impact you truly want to make in your life, your family's life, your community, and beyond. So really quick, we're going to go through what those 6 building blocks are, and then Martin is going to kind of deep dive into some of this information so that you can learn how to become your own bank. So building block number 1 is cash flow. This is the money coming in and out of your household and or your business. This building block is so important because with the other building blocks, you can't really do anything without cash flow, right? So the focus is always look at how you can get it up, get more cash flow. Okay, building block number 2 is debt management. Here, the focus is learning the difference between good debt and bad debt and how to use debt to increase your wealth. And also, we're always looking at, are you putting yourself at a stronger financial position or are you putting yourself at financial risk? This building block, people can think that they're strengthening their financial house and actually put themselves at risk. So it's very important to understand the difference. Building block number 3 is reserves. We saw how important reserves is just not too long ago in this worldwide shutdown pandemic. There was a lot of people making good money. Martin hates when people say good money, but they were making a lot of money. But you can be making a lot of money and still be living paycheck to paycheck. And when that paycheck stopped, people became financially destitute. So it's important to have reserves to strengthen your financial house. Building block number 4 is proper protection. This is the right types and right kinds of insurance, specifically life insurance, can secure the financial stability, the financial survival of your house and your business. Building block number 5 is build wealth. We all want to build wealth as much as we can, and we're going to talk a lot about it today. And here, the key is knowing not just how to build wealth, but what are the enemies to building wealth and how can those enemies destroy you and how can you overcome them. And building block number 6 is build legacy. These are having the right pieces of documents in place so that your wishes can be carried out while you're alive and while you're not. So real quick example is if I'm in a coma, who do I want making my medical and financial decisions? And after I pass away, what do I want to have done to my estate? And how do I keep the government and the public out of my business? So those are the 6 building blocks. Oh, now we're going to switch to something else, right? Those are the 6 building blocks. And at the end, we're going to show you how you can find out more exactly in your financial house, where you are in those 6 building blocks and how you can strengthen your financial house.
All right. So we're going to switch over to my part of this, and I'll explain to you how to implement some of the things we talked about. And also how does somebody become their own bank? How do you use the tools that's available to you? And I'll build towards that, and I'll show you some different examples. So,
and if you guys have questions along the way, feel free to put them in the comments. And if you know anyone that could benefit from this information, please share it.
All right. So here. Okay. All right. So just making sure you guys can see this okay, see our screen fine. Okay, so look, we're going to talk about how the wealthy banks and corporations use different financial strategies to build tax-free wealth without risk. Chelsea talks about some of the enemies of your money. Look, one of the biggest enemies of your money is taxes, and I'll demonstrate that as we go through here, so you can understand just the impact the taxes make on your wealth. So first, the main thing people need to understand is you got to learn how to think about things differently. So if there's results you're looking for and you don't have, it's either about something you don't know or something you're not doing. So all this stuff that we're talking about, I didn't know all of it from the beginning. I had to learn. So I started to learn and implement stuff, and then we started to get on a path to building wealth. And then we started to share all these different things with people. So then I'll show you examples of who use these strategies, who are the types of people that use these strategies, and how exactly do they use this type of strategy to build their own bank, leverage their wealth, and actually have their wealth working in multiple locations. How can you have your money working in one location and then leverage it and do things like buy real estate at cash flow? How do you do that exactly? So I'll talk about that here and show you exactly how to do it. But we'll talk first about the mindset and how to think about something, then from there, what to do. And anywhere along the way, if you have any questions, comments, or anything, feel free to drop that in there. We have somebody, Rain is on there. She's going to be commenting and letting us know that there's questions on there so that we can answer your questions for you. So first thing to understand is what did these 2 wealthy men do? Is 2 wealthy guys, one named Vanderbilt, one named Rothschild. How did they approach their wealth? And what were the results generations later in terms of what they did? So Vanderbilt was a guy, he died in 1877. He left $105 million. Out of that $105 million he left, they left $1 million to Central University, and now call it Vanderbilt University. So he left $104 million to his heirs. What happened to all that wealth? 95 years later, they had a family reunion in 1973. There were 170 descendants. There wasn't a single millionaire among them. So people talk about generational wealth, especially in certain communities, especially in the Black community. We talk a lot about generational wealth, but we also have to create the thinking behind it. How do you leave wealth for generations and make sure they don't squander it, right? Now, next guy is Rothschild. So Rothschild died in 1812. So he didn't just leave money, he also left instructions. He left knowledge, which is extremely important. Chelsea talked about knowledge, responsibility, and control. When you have knowledge, you can take more responsibility and have more control over your wealth and your finances. So when he died, he left a 3-part system for family wealth management. Try to make it simple and say, okay, if you guys do these things, this is how the wealth will stay in the family for generations and last a long, long time. So the first thing he said was the family's wealth was to be kept together in one family bank. We'll come to that, how you can do that for yourself and your family. Second thing is the family could take a loan from the family bank, but the loan must be repaid. So you can go to the bank, your family's bank, and you can actually take a loan against that. So let's say family member wants to go do a real estate deal, or a family member wants to go and buy a business. They'll go there and they'll talk about the deal, and they'll work out how to leverage that to make it all happen. So the family was working together as a unit. Now, this may or may not be your entire family. It could be your immediate family, or it could just start with you, with just the thinking and the mindset around that concept. Now, and the third thing is that he said was, the family must meet once a year to share the lessons learned. If not, they were out of the family bank. So everybody then started to have responsibility in contributing back to the whole group. And okay, I'm going to go, the things I've learned, I'm going to come and discuss that. So my family, we do a lot of the same things here. We have our immediate family, and I have an extended family. I was born in West Africa, like in Liberia in West Africa. I have a big family. My father had 10 children. So his father had 24 children. So it's a big family. and so with my siblings, we talk about money and finances. We actually have a Facebook Messenger group where we're constantly talking about financial things in there between us, what we're doing, and we help to take care of our grandmother. So we talk about all that kind of stuff. And so we're constantly talking about best practices, some of the things I'm doing as working, and all these different stuff like that, so everybody can be informed of what's happening financially. So that's one important thing that families can graduate to learning how to do. So when it comes to money, it's not just what you earn, it's how much of that money that you keep. So let's look at an example. Let's say I make $50,000 a year and I save all of that money, right? Which, of course, you're not going to be able to save every single penny, but if you make $50,000 a year and you actually saved all of it, how much would that turn into? If you were earning just 5% per year, after 40 years, so let's say somebody started at 25 and they were doing this, and at 65, they were saving $50,000 a year at 65, then after 40 years, how much money would that turn into? They will have over $6 million just earning 5% per year. So here's what that looks like visually. I want you to notice this chart here, how it goes up, this curve, right? That's that money accumulating. Started off a little bit and it accumulated over time to be a substantial amount of money. Now, we talked about the enemies of your wealth. Your largest bill that you have is your taxes. It's the largest bill you'll ever have, unless you get into a position where you can have some of your income and some of your money be tax-free. And some of the things we're going to talk about will show you exactly how to do that. But let's say this person making $50,000 a year, they pay 28% in taxes. The income after the taxes is $36,000. And let's say they were able to save all of that $36,000. They saved 100% of that money. They pay their tax and save everything. See, this red part down here is how much is reduced just because of that impact of taxes. See, the person has substantially less wealth because taxes are impacting how much wealth you can make. Now, here's what most people do. Here's the reality of how most people's finances are set up and what we're trying to help you to defeat, right? So if somebody makes $50,000 a year to pay their taxes, they're left with 36 grand. Out of the 36 grand, about 90% of that money is going to go towards their lifestyle, their debt service, their lifestyle, buying a car, taking a trip, all these different things they want to do. And then maybe they'll save 10% of that, maybe. And then let's say they save 10% of that and they were growing their money at 5% per year. These are just examples so that you can see the impact of taxes and the impact of how much money you actually put away, how much that could turn into. So this is how much is lost towards their lifestyle and the taxes. It's why people reach a certain age and only have a little bit of money there, and it's usually not enough. So when you start thinking about, wow, I need to confront how much money I'm paying in taxes. I need to confront how much money I'm actually putting away. What am I doing with this money? Where is it going? Is it sitting in a bank account where it's not earning much interest? Or am I using it to build my wealth? Am I using it to grow my capital and then using that to buy businesses, buy real estate, all these other different things? You have to start really looking at your money in a very, what's the word I'm looking for? Not consistent, but like intentional, a very intentional way looking at your money from that sense. All right, so there's 3 ways you can look at and view money. 1, as a spender. Number 2, as an investor. And number 3, as a banker. We're talking about how somebody builds their own bank. First, you have to think about money like a banker. We'll go and show you these 3 different ways. Number 1, the spender. Spender views money as just a way to buy stuff. Hey, I'm going to get money. I'm going to buy some shoes. I'm going to buy this. I'm going to buy that. every purchase costs him interest, because that money that he's spending to buy stuff, he's not actually putting to work for him. So the interest he would have made is not there because he didn't invest it. He didn't put it somewhere. So when you borrow money, there's two ways you spend money. You either borrow it or you pay cash. So whenever you borrow money, you pay interest to use somebody else's money for that thing you want to buy, or you pay cash for it. And when you pay cash, you actually are giving up the interest that you would have earned had you done it differently if you didn't pay cash. And we'll show you how you can do both. So let's look at, for example, a purchase that almost everybody makes, which is a car. 3 ways you can buy a car. 1, you can borrow cash to buy the car. You can pay cash for your car, like, oh, I pay cash for my car. Number 3, you can use a private family banking to buy a car, right? So first thing is, we're gonna look at some numbers here. Let's say I'm gonna buy, over my lifetime, I'm gonna make 11 purchases, gonna buy 11 cars over my lifetime, right? Here's what it will look like. And let's say every car I bought was $30,000, right? And every 5 years, I'm going to buy a new car every 5 years. So over a period of time, that's going to be 11 purchases I'm going to make in my lifetime with cars. So if I got charged 0% interest rate and I borrow the money and it was 0%, I didn't have to pay any interest, that $30,000 per car over 11 cars will cost me $330,000. The person who paid cash paid the same money because there's no interest. Now, what if my interest rate in financing that car was 5.5%, and I borrowed the money every time? I would have paid total $378,000 between the cost of the car and interest I would pay on it. Now, if I paid cash for it, $330,000. So a lot of people look at this and are like, well, pay cash. But I want you to understand, if you want to know how much the bank made off of financing that stuff, bank made $380,000 off of that, off of the frequency of you buying cars. Well, you got to have a car, right? So you got to go somewhere. So how do you do it effectively? So number 1, if somebody's going to borrow cash, here's what happens. First, you got to borrow the money, then you pay it back. Then you get back to 0. That's where everybody will like, I paid off my car, I paid off my house. So whenever you borrow something, you eventually pay it off and you get back to 0. So this person is going to do it over and over. I'm going to borrow, I want to pay, get back to 0. I'm going to borrow, pay, and get back to 0. Now, what if I was paying cash for my cars? First thing I got to do is I got to save the money. So first I would save the money, and then use it, and now I'm back at 0. I would save the money, and use it, now I'm back at 0. So you see, both the person who borrows and the person who pays cash, both of them end up back at 0. The guy pays off his car, he doesn't owe anything. The guy used all of his money, no more money. See, both end up back at 0. What if there was a third way to do simple things like buy a car, where you could create your own family bank and use your money to buy a car, right? So let's say this third way is I'm building my cash. Remember, we talked about how your cash keeps growing on this curve. And what if I was building that and I could leverage my money while still keeping my money working for me and buy the car at the same time without interrupting the growth of my money? Look how much more that grows if I don't have to stop every time. So this person was growing their money and stopped to pay cash. Now that money's no longer there earning them interest. They grow their money again, they take it out and pay cash. It's no longer there earning interest. People do this all the time, but they don't really think twice about, hey, I wonder how much my money would have grown into if I didn't take it out to pay cash for this car. So, and I'll come back to that so you understand the third way of using it. So one way is the way you have to view and use money is, one, a person looks at money as an investor, where they use money to buy investments. And every investment, if you're in an investment that has risk, you expose the risk so you could lose money. And typically when you have an investment and you make gains, there's taxes. So remember, we talked about taxes being one of the biggest enemies of your wealth because it reduces how much wealth you're going to end up having. So the other way to view money is as a banker. So we talk about viewing money as a spender. We talk about viewing money as an investor, where your money can go up and down in value. But look at viewing money as a banker. How does a banker view money? They view money as a way to make money. So a bank, if in a basic explanation, a bank is a financial institution that receives deposits and makes loans, right? So the banker, when he takes a deposit from you, how he's looking at it is, wow, this deposit I'm getting from you, I can use that to make money. They're using your money. So you go and put $10,000 in the bank. The bank doesn't just keep it sitting there. The bank puts it to work. They're taking your money. They may pay you 1%, but then they're going to charge other people 5, 10, 20% on that money that you deposit in a bank account. They're putting that money to work. All right. Every purchase is an opportunity to gain, and the banker always want to keep the money working, which is why the money never sits idle in the bank. The banker wants to keep making loans to qualified people. So they want to make loans. That's how they expand the balance sheet. They make loans to people because the loans is an asset to the bank. That's income to them. That's cash flow to them every month as you pay. It's a liability to you because you're having to pay it, but it's an asset to the bank. So I hope that makes sense. So the banker looks at compound interest, and which something Albert Einstein calls the most powerful force in the universe. And compound interest means the interest your money earn, you earning interest on top of interest you've already earned. So let's say this year my money makes some money. The next year that interest gets added on top of that, and more interest gets added on top of that. So it turns into this giant snowball of money, right? And that's what we call the wealth curve. Is your money compounding? See, it keeps building and building and building. And ideally, if your money just keeps building and building and building like this, you want that to continue forever. You want that to continue for generations if you can, because that's how your wealth keeps getting bigger and bigger and bigger with each generation. So when you start thinking that way, how can I have my money stay on the wealth curve? Have my money keep compounding? And how do I buy the real estate? How do I buy my cars? How do I buy businesses? Do all of that at the same time while keeping my money on the wealth curve. Then you're starting to think how a banker does. The banker is always thinking, I got to keep my money working. So it allows you to be the bank and stays on the wealth curve for the rest of your life. So every purchase costs us interest. Whether you pay cash or you finance it, it still costs you interest. The way it costs you interest when you pay cash is that money that you use to pay cash, you're no longer earning interest on. It's gone. It's in the car. It's in the thing you bought, whatever it is, but it's no longer earning you interest. So you either pay up interest to someone else or you give up the interest that you would have earned. So what if we could use our own money without giving up the interest it could earn? What if we have our money continually earning interest and still use it, still leverage it at the same time? So that's where creating a private family bank comes in. So it doesn't mean you go out and you go and charter a bank or like the bank you see on the side of the street. There's financial vehicles that you can use that can achieve the same result of you having your money working for you, and you can leverage it to buy assets that you want to buy. What time is it?
It is 12:29.
Okay. So number one, you want to create a pool of money, right? And then you put that money to work earning compound interest. And so that money just keeps earning compound interest, keeps getting larger and larger and larger. Then you want to use that pool of money as collateral when you need cash, which means you can have your money working in one location. And let's say it's on the wealth curve, it's building and building and building. It's earning interest and it's growing. You're not losing money, right? And then when you want to buy a car, you can use that money as collateral and leverage it to buy a car, to buy a property, to do different things like that. So you can, and when I say leverage it, I mean you can borrow against it. So you can borrow from your own bank and you can use that. And then instead of paying our normal bank that you would have paid, let's say you want to go buy a car, instead of paying them the interest, you can pay that to your own family bank because you're already earning interest on that. And instead of paying it somewhere else, you pay that on to yourself. So here's why I want you to think of this in a sense. And if there's any questions, let me know if this makes sense to you so far, what I'm explaining. If you have any questions along the way, drop a comment, questions, stuff like that, and we'll respond to it. So here's a question you should seriously consider whenever you're looking at financing things or growing your money. If your money was earning 4%, would it make sense for you to borrow money at 6%? Think about that. Your money's earning 4%. Would it make sense for you to borrow money at 6%? Now, the answer may surprise you because a lot of times people look, what normal people look at is they look at, oh, well, 6% is higher than 4. So it doesn't make sense for me to borrow. What you have to do is understand the basic math behind it. I'll get to that. Somebody says, what example is family bank? I'll get to that here in a second here. I wanted to give you some understanding so you understand this. Then next couple of slides, we'll address that. So let's say I go to buy a car, and the car costs $30,000, and interest rate, and I'm going to finance this car for 5 years, and I'm paying 6% interest. My monthly payments will be $580 per month. I would spend $34,799. What if I had $30,000 in savings? My 4% that I'm earning on that savings would make it after 5 years $36,000. So here's what a lot of people do. I want to go buy this car. The car costs 30 grand. I got 30 grand saved. It's earning me 4%. But if I want to finance this car, the interest rate is 6%. And what they'll say is, you know what? I'll just pay cash for the car. That's what they end up doing. They're like, I'll just pay cash for the car. They pay cash for the car without doing the math. Had they not done that, see, their money would have grown higher than the cost to borrow, even though the interest rate was higher. Because whenever you're paying debt down, you're paying it down to an end date. And when your money is compounding, your money is getting larger and larger every year. So after that same period of time, this person, it would have made sense for them to keep their money working and finance the car. What would have made even better sense was if they had their money in a vehicle that they could borrow against it and use that to buy the car and then pay themselves back this $580, put that back into their own. That way they're increasing their wealth even faster. So there's 3 places you can put your money to work. Main places: stock market, real estate, and financial instruments with guarantees. So somebody asking examples of family banks. So some basic places people put their money when they don't want to lose money is they put their money in savings accounts, they use CDs at the bank, or they use insurance contracts. So what we use for our personal family bank is a type of life insurance policy that allows us to store cash in a life insurance policy. And I'll explain how that works, and I'll show you some numbers behind it. It allows me, instead of storing my money in a bank account, I could store my money inside of a life insurance policy that grows. It earns compound interest without losses, so I don't lose any money. And then it grows, and whenever I want to buy things, I can go take a loan against that policy. Now, I'm not taking a loan from my money. My money stays in that policy, continues to earn compound interest. I'm just simply borrowing against it, which means I'm using it as the collateral, but it keeps growing. It doesn't stop. So it keeps growing, and then I use the loans I take against it to buy real estate and to buy other assets like that, other things like a business and stuff like that. What that achieves for me is I can have my money working in one location, which is inside of the policy. I leverage it, borrow against it to buy real estate. Now I have a second asset. Remember, I have one pool of money. I leverage it to buy a second asset. The real estate cash flows. So generally we're looking at buying real estate that cash flows, that has tenants in there, that's paying you money every month. So it's a income producing asset. And then you now have your money working for you and cash flow in real estate. So if I'm going to use a vehicle to build my family bank with, here's are the things that I would want to have in that vehicle. One, I wouldn't want any risk with it. I wouldn't want to risk the money because I don't want to lose the money. I would want guarantees. I want to not have penalties associated with that money. I want something called liquidity, use, and control. Meaning, if I need access to that money fast, I can get to it. If I see a real estate deal that comes up and I need to get access to that money quickly, I want that money to be in my bank account quickly. Whether it's a matter of a day or two or faster than that, you want to be able to access and leverage that money quickly. I would want that money especially protected from creditors. We're dealing with somebody who patriarch or the family passed away, and they had creditors, right? Some people are still trying to sue that person's estate to get some money from them, even though the person is gone. They're like, well, your debts are still outstanding. So money inside of the policy is protected from creditors, protected in those types of situations. And then leverage. Leverage means creating the most amount of wealth using the least amount of money. If I can have my money working in one location, leverage it, I can buy multiple assets while keeping my money working for me. Does that all make sense so far? Just let me know if you have any questions. If it makes sense, let me know if it makes sense. Drop it in the comments what I'm saying so far. You would want your money, remember we talked about taxes, one of the enemies of your wealth. While your money's working, you'd want it to grow tax deferred. No taxes while the wealth is building. And I would want to access the money tax free. And I want to be able to use that money as collateral for loans I'm going to take. That way I can keep my money working all the time and then leverage it to buy the things I want to buy along the way. So you want to be able to, we're using life insurance here for its banking functions. We're not using life insurance as an investment. We're using it for its banking functions. We're banking through life insurance. We're just happy to be an efficient vehicle that we can store money in that can grow without taxes and that I can leverage. And then I can have that in case I leverage it and I die, I still have a death benefit that will go to my family tax free. No matter how large that death benefit is, it's gonna be $100 million. It will still go to my family tax free.
People saying making lots of sense.
Okay, good. I can see all the comments right here, so that's good. Thanks, Jeanette. I see your comment. And there's some ways the payments can be tax deductible, especially if you fund it through a business. If you become disabled, you have plans where the money can still be put in as disabled. And you can transfer money to your heirs tax-free, which is a phenomenal thing to be able to do that.
Making sense. Jesus, my hand is cramping. I'm writing so fast.
Okay. All right. So
here's a quick question. If I already have life insurance policy, do I have to cancel it to create my own bank with you guys?
No, not necessarily. We can look at your policy, but you can have multiple policies. You can have, I have multiple life insurance policies. Chelsea has policies. Our teenage son has policy. So you can have more than one life insurance policy. You can have multiple policies, as many as the insurance company can issue you. So we can look at what you have and then and see if that makes sense. And we'll share with you guys. You can also get a free strategy call with us where we'll look at your specific situation and see what makes sense for you to do. And we can actually put some examples together for you. And before we end up here, I will show you examples of some numbers so you guys can see what it looks like, how you can actually use it, all those kinds of things. And we'll customize that for every single person. So we can build out a plan that's specific to you, your income, your situation, your goals. We do that at no cost to our clients when we do a strategy call. So you're going to do a free strategy call with us here. So make sure to stay tuned through the end. We'll let you guys know how to do that. So we use the same financial instruments banks put their money. I don't have too much time to go into some of that today, but your Bank of America, Chase, Wells Fargo, all of these banks have collectively hundreds of billions of dollars in cash in life insurance policies. This is not money sitting in a bank. They push money inside of life insurance policies. They're called bank-owned life insurance. And the FDIC recommends it as a place they can store their tier 1 capital. They're some of their safest capital that they can put things into is in something called bank-owned life insurance, where a bank actually owns a life insurance policy. And the question you should ask yourself, why would a bank that's not a living entity want to own life insurance? Because of all the tax advantage and different things I was telling you about as a store of money, where they can also keep money compounding. That's one of the reasons why it's done. All right, so we customize life insurance policies that give people liquidity, safety, guaranteed growth, protection from taxes, protection from judgments, lawsuits, things like that. And people use that as their family bank. So you build up a pool of money, and then you can leverage that to buy real estate. You can leverage the policy to pay down your debt. You can leverage the policy to buy cash. We usually buy cars. We usually use it on income producing assets, like businesses. So now here's an example. There's a bunch of numbers on the screen, but I highlighted something. here. And this is one example. These plans are customized. If you can't see them super clear, that's all right. I will read some of the stuff to you. And this is just one example. We customize them for people. And there's different types of life insurance we can use to achieve the goal here.
If you turn your screen sideways, if you're on your phone, it makes the picture a little bit bigger.
Yeah. This was an example of, we had somebody's 35 years old and they were putting $1,000 a month away into building their family bank. And they're going to be leveraging that along the way. So in this example, here's what it turns into. So this person's 35, they're going to fund it till age 70 and they're going to stop. So $1,000 a month is $12,000 a year. After age 70, they're going to stop and they're not going to put more money into this plan, right? At age 70, they would have accumulated in their policy in cash $1,339,000 projected cash value that's highlighted here. $1,339,000 is what would have accumulated over that period of time. Now, this person can use this money for retirement income. They can use this money for all kinds of stuff. Now, the policy, the family would get this 1.3 million plus the initial amount of life insurance that was on this policy from day one, which was around 300,000 or so. It's close to that. And so the total benefit that would go to the family as the person died at age 70 was 1.6 million. Now we've created, that's somebody creating generational wealth. They created an estate, and then they can pass on 1.6 million. All of that would be tax-free to their family. Now I'm going to show you how you can use it sooner because you don't have to wait till age 70 to use it. You can use it sometimes after the first year, sometimes during the first year, stuff like that. So in this case, this person's been funding it. This is the earlier years to start at age 35. So let's say they've been funding it at year 8. The policy's got $100,000 of cash built up in it. Now they can go and leverage that to go and buy an apartment building. Now, when you borrow against your policy, in this scenario, the money doesn't leave the policy. The money stays in the policy and continues to earn interest. So if my money's working in my policy, I leverage it. So I'm thinking my policy as my own personal family bank. And then I leverage that and I go and buy an apartment building. I now have used one asset, my life insurance policy, and turned it into 2 assets. Now I've got this life insurance that's cash flowing to me. And life insurance loans are very unique. Because you're using your money as collateral when you take a life insurance loan, it doesn't show up on your credit report, and it's not based on your income. So they don't ask for your income. It's not based on what your credit score is. It's simply based on, do you have money inside of that bank, that quote unquote bank? Have you built? So you put money, you fund it, you capitalize it, you take some of your surplus, you push money inside of the policy, and then you turn around, you leverage that for buying other assets with. Now, with this scenario here, the person uses that to buy real estate, and now they have money compounding. From day one, there's a death benefit on this policy. So this person started to build their family bank, and the next day they died. That family will still get money paid to them tax-free because it's a life insurance policy. So you have a cash value in the life insurance policy, and then you also have a death benefit that would payable to the family. Right. So, and then there's each year there's different amounts as the policy earns interest and accumulates over time. You get access to money they can borrow against to use for different things. So, as a quick visual on this, we like to use it for real estate. We're shopping for assisted living real estate. We like that. We may do some flips. We may look at multifamily. We have a lot of our clients do a lot of real estate, own a lot of real estate, own multifamily real estate, self-storage real estate, mobile homes, all of that. So we have a network of clients who do a lot of different types of real estate. And so people come to us and they want to do real estate, but they don't have enough capital yet. And so they're building it up. They're establishing funding and capitalizing their personal family bank, and then using that to buy assets. So first, a person will put money inside of a life insurance policy. Not every life insurance policy does this. It has to be specifically designed. It has to be certain types of life insurance policies that you do. You have to be designed a specific way if the focus is on cash building, right? Focus on cash accumulation has to be designed a certain way for that. So we customize it and design it. So the person builds it up. They want to buy real estate, leverage it to buy this real estate. The real estate cash flows. Now you can push that back into the policy, or you can use that for your lifestyle. And with a life insurance policy, you can take multiple loans against your policy as long as you have cash in there. It's not limited to just one loan. And when you take a loan against your life insurance policy, you don't have to pay it back on a set schedule. So here's how this would come into play. If I leverage my policy to go buy a property I want to flip, and let's say it's taking me longer to flip that property, or I want to have more time to do some work on it and things like that. Because I'm not having to pay that loan back the first of every month, like a normal loan you take in America, it gives me more flexibility because I'm flexible how I pay that loan back on a policy. And if I didn't pay the loan back and I died, the death benefit will pay off the loan and the rest of the money will go to my family in a simplistic sense. So this allows me to acquire multiple pieces of real estate and get cash flow from all of that. And you don't have to be 65 or 70 to wait to create cash flow like you have with a normal traditional retirement account. You can start building cash flow a lot sooner, right? So without getting too much into the weeds, I wanted to just kind of go over those pieces for you. I'm going to flip back over to the main thing so I can see the comments and stuff like that.
Yeah, so there's a question. In order to get this policy, does it require a physical? Does your health play a factor in your decision?
Is that Iggy? It's my nephew on there. What's up, Iggy? So the physical, depending, there's nowadays insurance, what's called underwriting, which means getting approved for a life insurance policy, has become more sophisticated. We can get people approved for up to $2 million without having to do lab work. So you don't have to answer some health questions. And nowadays, the insurance company have technology where they know if you have a certain prescription and stuff like that, so they can look in the prescription database and see if there's any prescriptions you've had that could impact your qualification for life insurance. But no, it's pretty easy. Even if you got diabetes, high blood pressure, stuff like that, you can still qualify for life insurance. Now
the question is, if my job gives me life insurance for free and I have my own policy as well, how much do I actually need? Like a ballpark figure.
So a common rule of thumb, and it depends on if you have dependents, if you have a spouse, if you have, you own your home, stuff like that, where you might have things you might want to handle financially if anything happened to you. A good rule of thumb that we recommend is about 10 times your income in life insurance. So somebody has $500,000. If somebody's income is $50,000 a year, they should have about $500,000 of life insurance. And there's a reasoning behind that. And it has to do with cash flow. I'm a big believer in cash flow. So if I have $50,000, if I leave my family $500,000, they could realistically get about $25,000 a year off that money in terms of cash flow. I could leave about half of my income. So if I make $100,000 a year and I leave my family $1 million, my family can get about $50,000 a year in cash flow off of that $1 million pretty easily. And so without drastically impacting the principal that I left, so that they can live off that $50,000. I wouldn't if I leave my family $1 million, they're not going to take it and pay off the house. Remember, if we do that, we're giving up the interest that money would have been earning. So the family will not go and take $500,000 and pay off the house. The family will use that money to invest and get cash flow, and use the cash flow to pay the service, the debt on the property and stuff like that, while still keeping our money building and expanding. I'm all about expansion, growing my wealth, and those kinds of things. That's what I'm a big believer in. So for those of you who you can get a free strategy call with us where we go over your personal financial situation with myself or somebody on our team. And you can go to 6buildingblocks.com/strategy. You can request a free strategy call there. We'll go over and talk to you about your specific situation. We'll go over and talk about these 6 building blocks. And some of you guys already actually scheduled strategy calls with us. And we'll help you figure out what's the best thing to do for yourself and your family. Were there other questions or anything like that?
No, I think we covered the ones that I saw.
All right, so George said, looking forward to speaking with you. So look, guys, this is, I say all of these things as somebody who I've had different licenses. I've built investment portfolios for people who do all kinds of cool stuff on the investment side. I've been the advisor to companies' 401k plans, where I'm the advisor on the plan for the whole company. We go and set up 401k plans for companies. So we've done all of those things. And over the years, I've just looked at what do people want? What are they looking for? And what actually makes sense? So most people want financial freedom. So first they want financial stability. Then from there, you want financial freedom. So financial stability means you're paying your expenses. You don't have to worry so much about all those kinds of things. And financial freedom is where you have enough passive income coming to you or enough cash flow coming to you that you don't have to go out and earn every day or every week. So then you're free financially because your lifestyle is being taken care of. So how you're taught in America is you should plan to get income coming to you when you're 65 or when you're 70. So you put money into a retirement account. They tell you don't touch it until you're 70. All right. And then you put it in the stock market, which I have licenses to do all of that. The problem is it goes up and down. So you can't actually predict how much money you're actually going to have. You can guess, but you can't really predict how much money you're going to have because you don't know what it's going to do. So then you get to retirement, and then finally you're now supposed to start taking this money out and enjoying it. Well, you're so worried because you don't have enough, and you're worried that money's going to run out. So it's not an efficient way to plan anything. It's not an efficient way to plan anything. I like simplicity. I like things real simple. All right, I know real estate, anybody can understand it. There's a house. Somebody lives in a house. Somebody either owns it or they rent it. If they rent, they pay somebody rent. The person who owns it get money every month paid to them as rent. That is cash flow, right? The person doesn't have to do anything specifically besides maintain that property to get the rent paid to them every month. Anybody can understand that. Life insurance, there's cash in a policy. You can borrow against the cash. Your money keeps working for you. Okay, great. Somebody dies, money goes to their family. Simple. It doesn't have to be super complicated. So we like the combination of life insurance and real estate because life insurance allows us to compound our wealth and get tax advantages, and real estate allows you to get cash flow. So, Sonia says, she asked, there are compound interest accounts available instead of putting money in a high yield savings account. Yeah. So what we have been talking about, I don't know how long you've been on the stream here with us, Sonia, is one of the places that we use, and we're talking about establishing a personal family bank, is we use life insurance for its banking function, because the life insurance compound interest, we generally get a much higher interest rate than what we get at the bank. So we use that. Plus we have a life insurance death benefit. And because it is inside of a life insurance policy, that money grows without any taxes, and we can access it without having to pay any taxes on it. It's just a tax code that regulates life insurance. As long as it meets the definition of a life insurance policy, you have the tax advantages of a life insurance policy there. So that's what we use, because we can accumulate our money inside of a policy, and we can use it without taking the money out. We just simply take a loan against it to use it for things like that. So for those of you who want to understand this better, you can go to 6buildingblocks.com/strategy. And it's number 6. I think Rain has been putting it in the comments. Rain, why don't you drop it in there one more time so I can put it up on the screen, or maybe I can find it in here. 6buildingblocks.com/strategy. You can request a free strategy call right here. 6buildingblocks.com/strategy. You can request a free strategy call with us. We'll go through this and make sure you understand it very well. But it's a simple concept for people to understand. A lot of people grasp it after they hear it a couple of times. Did you see any other questions or something like that?
Well, someone says your professionalism is amazing. I'm an advisor who would like for you to mentor me or join your team. Oh,
thank you. Send me a DM. Send me a DM. Let me know where you are. And I really appreciate that. That's one of the best compliments that we get, because I do get a lot of people who are in our industry do reach out to me and ask those same kinds of questions. So I really appreciate that. That's a great compliment for us. And also to get the free ebook, free digital copy of our book. So we have this book, Let's Fight About Money. It's about couples and money. But we actually also talk about your kids. You want to do this part, Chelsea?
Well, I'm not sure what you're going to say, but we'll talk about your kids.
We don't talk about your kids. we
Talk about your kids in this book.
We talk about, it's just letsfootaboutmoney.com/ebook, right? Just letsfootaboutmoney/ebook. So here with this, you can get a free digital copy of this book. We talk about getting on the same page with your spouse, with your partner, or just understanding about money, and also how to teach your kids about money. We have a whole chapter in here about teaching your kids about money, how to communicate about money, handle conflicts, build an unbreakable financial house. Yeah, Mitch works with us. Says Martin is an awesome mentor. We're 2 years with him. Thanks, Mitch. Appreciate you, buddy. So if there's any other questions, feel free to send us a DM. Thanks for the comments. If you guys shared, just put #shared. Thanks for your shares. Thanks for watching here with us. About twice a month, we're going to be doing video series like this where we talk about different topics, different things around your finances, different things around 6 building blocks to building wealth, all of these different things just to help you become more educated. All of these webinars that we do are free. You can watch them, and all that kind of stuff. So anything else you want to say before we wrap up?
Well, just thanks for tuning in and joining us. We hope that you got value and that we helped increase your knowledge so that you can really understand what options are available to you, so you can take responsibility for your actions, your decisions, your results, and have more control over your life so that you can really build that unbreakable financial house. And we would love to speak to you and help you look at each area of your financial house, the 6 building blocks, and look at what your numbers would look like in creating your own bank. So click that link, 6buildingblocks.com/strategy. We'll be happy to set up a call with you and help you.
All right. Thanks, guys. Have a good rest of your day.